We have seen increased volatility on financial markets in recent weeks. All of this has to do with weaker economic data. For example, in the euro area, growth declined to 0.2% in the second quarter of this year. Also in the US, growth disappointed in the second quarter, and this is actually kind of global phenomenon that we see everywhere. Now, lower growth ultimately means that businesses are under pressure and so on, and this is causing a little bit of concern in financial markets. At the same time, there are lots of uncertainties still around. Think of the Brexit. Will it be a soft Brexit or will it be a hard Brexit? Well, the new British government with Boris Johnson is clearly heading for a hard Brexit. And a hard Brexit, that's a situation where, for example, many companies are not prepared for. So therefore, all these uncertainties, as well as these economic data, weigh on expectations, and there's a general fear for a recession upcoming. In particular, data for Germany are disappointing. For example, if you look at industrial production figures for Germany, they're clearly going down, and they keep going down. And this is a clear signal that the strong German economy is suffering from global trade tensions. Think of the US-China trade war, as well as suffering also from technological developments, for example, in the automotive industry. Obviously, if the strong and important German economy is cooling down, this has also an impact on the European growth outlook. Now, given the more negative economic outlook, it's clear that central banks stand ready to intervene, and financial markets are expecting a lot from central banks. We don't believe that central banks will stimulate the economy to the extent that financial markets are currently believing, but still we expect that the Federal Reserve will cut interest rates twice after a first rate cut this summer. And also the European Central Bank is very likely to cut interest rates and probably to relaunch its program of quantitative easing. Now, more monetary stimulus will definitely help to avoid a full-blown recession, but the question is obviously whether it will be enough to really avoid a recession after all. The expectations about more monetary stimulus, as well as all these risk factors, also explain why long-term interest rates are substantially lower and even more negative, for example, in Germany and many other European countries. Generally speaking, we see that investors are looking for a safe haven. They're looking for investments with a relatively low risk and at the same time with still some return. But since so many people are looking for these kind of instruments, ultimately interests keep on going down and ultimately become negative and even substantially negative. Although there might be some market overshooting here because markets are expecting too much from central banks, and maybe some of the risk factors after all may turn out much more positively than we currently expect, still the expectation is that these negative interest rates will go on for a while, and it will take a while before they start normalizing and return to more positive and again positive levels. Well, apart from the obvious risks like a hard Brexit and an escalation in the trade war, there are many new risk factors popping up. Think, for example, of a trade conflict between Japan and South Korea, traditionally very strong allies, but currently they are increasing tariffs on each other's products because they have a serious political dispute. It signals, obviously, that protectionism is all around, and this may again hinder economic development. Also think of the Italian government that collapsed, and we are now heading for new elections in Italy. Well, it depends, of course, which new coalition we get in Italy, whether we will have a stable political environment and in particular a government that can help to reform the Italian economy and to improve the Italian budget. So in a nutshell, we can say that there is a general fear for a recession, and based on economic data and all the risk factors, it's definitely clear that we are heading for a recession, at least in some countries, for example in Germany. But nevertheless, economic data is still sufficiently strong that the real economy is clearly outperforming the reaction on financial markets at this moment. Nevertheless, we have to remain very vigilant what the future will bring, and it's clear that the prolonged period of uncertainty is still upcoming.